Welcome to the 2025 review. This is going to be the out of sample where I show every single strategy that was shared and taught in this series. And then I assume that you started trading 1 month after I introduced it. So, for example, the January strategy where I showed the 10-day breakout and low IBS, I start looking at the out of sample results if you started trading it starting in February 2025. And so my goal here is to stop updating this playlist except for an end of year review, probably every year, just to show how these strategies have performed out of sample. So let's go ahead and look at the 10-day breakout and low IBS. Looks like it only took 5 trades, and 4 out of the 5 were winners. And so with these 5 trades, you would have had a return of $2,583.50, assuming that you traded a single 0.7 delta 60 plus days expiration call option, which, assuming you started with a $10,000 account, which is like the bare minimum I would recommend to safely trade this entire portfolio. A safer, I guess, more risk adverse trader would probably start with 15 to 20,000, but assuming you started with 10,000, you could easily afford a actually multiple 0.7 delta 60 plus days expiration call options as a proxy for having to buy 70 shares. And so that's the total return for just the strategy shared in January with the max open drawdown of around $900. One of the things that you'll have to get used to if you're not used to trading live is a lot of times your max open drawdown while you're in a position is almost always going to be greater than your realized loss. And so, yeah, that's just something to understand, that a lot of times when we're building these equity curves, they usually just show the closed trade results. And that's where things can get misleading, because the joke about what people call equity curve porn is they show these beautiful backtest results, but then you look at the max equity drawdown and it's just something insane. Like, they held through absolutely bizarre drawdowns. And this is especially true in Bitcoin, where you're like, could you actually trade that? You'd lose like 25% of your account for certain Bitcoin strategies I've seen online. But anyway, so this strategy here, you've got about a 25% return. If you had a $10,000 account and you traded only this strategy with one call option, you would have taken 5 trades in a single year. You would have made 25%. All right, so now let's look at the bearish engulfing low IBS. This was introduced in February, and so these returns assume that you traded between March to December. Same thing, roughly 0.7 delta 60 plus days expiration call option as a proxy for 70 shares. And you would have made about a little bit over $1,500 with a max open drawdown of about $300 for those trades. It's about 15% gain just from this strategy. So even if you only traded the 2 strategies I shared earlier in this series, you would have had about a 40% gain before taxes. All right, now let's look at channel mean reversion. This was shared in March. And so from April 2025 to December 2025, there were 2 trades taken, both were winners. And then the total return is about $2,411.40 with a max open drawdown with being about $120. So this one's also pretty good. And one thing you'll notice about all these strategies is they don't trade very often. That's something I covered in the beginning of the series, is that all of these are capturing different edges and then you're combining them together into a single portfolio that massively will beat buy and hold, and also will have low correlation with each other. And so they kind of help balance each other out and give you different reasons for being in the market. All right, so the short strategy that I introduced in April, the out of sample from May to December 2025, as you guys know, this year had a tariff scare that sent the markets down. And I presented this short strategy in April as a way to take advantage of that should the market continue to go down. And in May, the market started to turn around and head back up. So as you would hope, the short strategy does not take any trades this year, at least not in May to December, and so the filters would have done their job and prevented you from losing any money from shorting a reversal. All right, so this one didn't trade like hardly at all, and arguably the returns are kind of negligible here. This is the day of week seasonality strategy, looking for specific conditions on a Monday, and it takes only one trade, makes about $300 while having a open drawdown of about $65. All right, then let's look at this one. This is a end of month seasonality. When you're looking at a specific pattern that tends to occur if the last trading day of a month exhibits certain features. And so this one traded for roughly half the year, or at least was running for half the year out of sample because it was introduced in June. And this is a great example of what I mean by max open drawdown. So a lot of these equity curves you see online, the drawdowns don't look bad because they're showing you the closed trade drawdown. One thing to understand here is that with this trade, you would have had to stomach a almost, a little bit over of a $700 drawdown. Of course, it would come back and recover almost all of that by the time the exit condition was fulfilled, but you would still had to, at one point, lived through a $700 open loss. Okay, let's look at the Santa Claus rally. Oh, I forgot to update the slide at the top. So it's not actually to be determined anymore. This trade concluded in early January of 2026 because it's capturing the Santa Claus rally. And that's a well-known seasonal effect based around holidays. But this year was a bit of an anomaly in many ways. And this was actually a losing trade this year. So again, the closed return is a little bit over $100 loss. The open drawdown was about 3.5 times the actual closed loss. So again, it's just something to keep in mind. All right, now this one, gap up, open, and low IBS. Again, this is capturing a very specific effect when the market opens with a gap up, but then closes near the bottom of its bar, which in October, no, not October, in August when I was presenting the strategy, I mentioned that one way to interpret it is that the market's ready to move higher, but isn't the big players aren't positioned yet and need to reposition. And then I presented some statistical evidence showing that anytime there's a gap up open, there were usually higher prices within like 5 days or something. I don't fully remember, but we added a filter to improve the general metrics, like the profit factor, win rate, and whatnot. And so I believe the market had several gap ups this year, but only one met the low IBS requirement, and that one netted a little bit over $1,000 return with a max open drawdown of about $120. And then the ultimate oscillator. This is one of my favorite swing trading oscillators, built by one of the best vetted traders out there, Larry Williams. You might have heard of him because he traded in the World Futures Trading Championship and holds the record for the highest winning return ever achieved. He returned somewhere around 1,100%, which is basically taking the starting account value in that competition and then having it, basically multiplying it by 10, or actually technically 12, I believe, in the time the competition's over. And so it's believed that no one will ever be able to top that achievement because of how insane it is. But he made the ultimate oscillator. I presented it in September, so we're only looking at October to December. There was one trade taken, and the performance is pretty good. All right, so even days. This is the statistical effect where even days tend to be more bullish than odd days. And this one only took one trade because was really only given 2 months. It was presented in October, so we've got 2 months out of sample here. Took one trade, closed for $466 loss. The open drawdown was over $1,000. That can be a lot to stomach, but that is something to keep in mind. Is that again, the exit conditions are often chosen the way they are because they're good whenever the strategy wins, and they're also good when the strategy is losing. So here you would have probably gone to bed feeling pretty bad about that $1,000 open drawdown, but then happy to see that over half of that was recovered by the time the trade was closed. And then intermarket with gold. This one was presented in November, and with such a short out of sample period, especially because December is a holiday month, so there's not that much volume and movement in general in the last week of the month. There were no trades taken by this strategy. All right, so if we add all of this up, then what we have here is roughly an 84% return. So if you start with $10,000, which is what I would say the bare minimum, when I say that, I mean it's not truly the bare minimum. You could actually have traded this with about $5,000, but I think it'd be hard to stomach a $1,000 open drawdown, which is like 20% of your account. If you started with $5,000, it's a little bit easier to stomach that when you started with 10,000. So if you started with a $5,000 account, you actually would have, gained. You would have gained 8,000, almost 8,500, and so therefore you would have gained more than the starting account value. But the safer value to start with is 10,000, and with 10,000 you would have gained 84% return, minus any sort of crazy slippage that you would have encountered in the market, and still would have yielded about an 80% return. Your largest open drawdown being about 10%. And that's coming from the even day strategy. And when I say open drawdown, your open drawdown is almost always going to be larger than your actual close drawdown. I think your actual close drawdown here is that even days minus 466. So that's about a 5% actual realized drawdown, I should say. But I like to look at the open drawdown because that's what you're actually sleeping with at night, and that's something that most other YouTubers who I question are actually traders often neglect. And then the last thing that they often neglect is the fact that you do have to pay taxes. So your after-tax return, and this is assuming you have a short-term tax rate of 25%. My personal short-term tax rate is closer to 30%. So my personal after-tax return is worse. But here, even after taxes, you would have yielded about a 63%. Let's say you had, really bad slippage. I don't know, you paid some other fees or whatnot. You still would have at least made, in my opinion, $6,000. So that's about a 60% return on your $10,000, which is honestly pretty good. And the last thing I want to talk about in terms of all of these strategies is, we talked about in this series a lot of these, they exit with close greater than the high of the prior day, and that's just because what we're trying to capture in the market, that captures the idea, the essence of it. But other ways to explore or at least capture that same idea that I haven't explored personally, but you could consider is, what if you instead exited when the IBS was greater than 0.9? Another one is when the RSI2 is above 90. These might improve the performance. Just keep in mind that if you do this, you technically have created a different backtest, and so you will want to incubate and check the out of sample for some amount of time with these new exit conditions, rather than simply saying, "Oh, okay, well the backtest has improved." And I say all of that because if you've already looked at the results so far, then you have look ahead bias. You already kind of know that, okay, these strategies did well in 2025, and like pretty much ever since the inception of SPY, these strategies have done well. So, you already have some bias there, and so you want to um, think about the difference between what is close greater than the high of yesterday mean versus simply closing in the uh, upper range of the bar, which is essentially what IBS greater than zero point 0.9 means, or greater than the 2-day RSI. There's some nuance there you'll want to consider. And then this is the part where I'm actually going to deviate from simply showing slides and talk about um, what my goals for 2026, or at least one of them in terms of what I'm doing with this channel. So I have taken the strategies that I've shown in this series and I've converted a good number of them to intraday variants. And part of that is because I wanted to show uh, like with actual real evidence rather than simply saying, oh, not taking the approach other YouTubers do, but like actually show that I can take an algo strategy and I can grow a small account and I can grow a funded prop account and get a payout. Um, I think there are better strategies, honestly. Most of my actual portfolio, like I have a curated portfolio that I run live on my personal accounts, and I have a separate one that I've also curated for prop accounts that trade more than just MES. But I do want to prove that these strategies can be adapted for prop firms. And so my goal for 2026 is to demonstrate that. So the intraday variant is, if you watch the video on the intermarket with gold, it's kind of the same thing. So what I've done is it pulls SPY data, like daily data, for the signal generation, and then it correlates that with MES. Obviously, SPY is heavily correlated with MES, but essentially what it does is it says, okay, if we have a signal on SPY, and what was the equivalent of that daily close? What was the equivalent of that day's high in MES? That way we know like what our actual exit conditions are in MES, since we're taking them on technically a different instrument. And the second thing is that usually when you have a small account, you cannot, like if you had a $5,000 account, you can't hold overnight. So normally you would just want to hold. That way you're not paying subject to commission again, and just hold until the exit condition. And most prop firms do not allow this. They require you to exit. Most will require you to exit by 5 p.m. I wasn't sure whether I wanted to build this to work with Top Step or not. So I just said, you know what, SPY's close is technically around 4 p.m. ish Eastern time, and so we're just gonna align it in the futures. We're just gonna make sure we always exit by 4 p.m. In the MES variant, and then what it does is it will just market order into the overnight session after it opens, if the trade needs to continue. So it's sort of like simulating a swing trade without holding for that um, that 1 hour, like 4 to 5 p.m. and then the 5 p.m. to 6 p.m. that the futures are closed, just to work around two things. One is the prop firm restriction of you cannot hold overnight. And by overnight, I hate the term overnight. It's like you can't hold in the 1 hour the futures are closed is really the correct way to put it. And then the second restriction, which is that the margin requirement. So in a $5,000 account, you don't have much room for um, much margin at all. But if you are technically day trading, meaning you don't hold during that hour the futures are closed, then you can absolutely do this with $5,000. So what I want to show is what I have built so far. So let's go ahead and Let's go ahead and quit this. Let me just go straight into the live demonstration. So this is what I've built so far, and this is what it looks like. Oh yeah, it's gonna have to pull data. So let me just go ahead and start that way. It starts pulling the data from Rhythmic because it's gonna take some time to build these quotes from 2020 to essentially 2026. I don't have any Blue Sky accounts currently, and that's why I'm connected to Blue Sky because my actual prop firm accounts are running on a VPS, and I don't want to. You can't have duplicate connections. So this is taking. I wish I could make the font size bigger, but this is taking the strategies I have shown in this series and it's putting them into a single strategy in Quantower, like a super strategy, where I can essentially run them. And you'll notice that I can set a number here for each of them. That's the priority. So in case there's ever two strategies firing at the same time, there has to be a way to say, I want you to take like one strategy signal instead of another strategy signal. And so I pretty much just ranked them by profit factor. So if we have collision between the 10-day high and low IBS and I didn't even show the MACD histogram fall strategy, but let's say the channel mean reversion, then it will take the 10-day high and low IBS signal rather than the channel mean reversion, and it'll use the 10-day high and low IBS exit condition as well. But the reason why there's some other strategies in here is because this is representing my full portfolio that I trade on SPY normally. And it's turning it into a version that trades on either ES or MES. As you can see here, I can pick one symbol for the data and then another symbol to actually take the trades. And so that's why there are some strategies that aren't technically part of the series that I personally run that are in this Quantower strategy. And there's all the user inputs and whatnot. The other thing I want to point out is that whenever I was building the infrastructure for this to verify that it would work with a prop firm, a lot of prop firms, they give you a $2,000 trailing threshold. So essentially that's what this is. So here we have the stats as it's running. We've got the net P&L, gross P&L, the total amount paid in fees, the running profit factor, and then to calculate the trailing threshold, essentially you have to follow the highest value that the account balance has ever achieved, subtract it by the lowest the account balance ever was, and then add the current net P&L. Because obviously if the account balance, the lowest it's ever been was 98831, but then you've already gained like 7,000 in profit. You have to look at what's the difference between the high and the highest the account's ever been and like the net P&L. So essentially you can see here the trailing drawdown threshold. This is all with one MES. And this is running from 2020 pretty much to 2025. I don't have all 15 to, well, I think it's closer to 18 I'm running in my actual SPY portfolio, but I will eventually get them all in here. And then I'll probably adjust the lot sizes because some of the higher profit factor strategies can definitely run with more than one MES. While some of the ones that are a little bit weaker, I'll probably just stick with one MES and then do a check to make sure that the max drawdown, and this is max open drawdown, by the way. This isn't closed. I'll show you as soon as this is done running that it will give you a different number in the backtest result, and that represents the closed drawdown. So here, let's go ahead and look at this. So this is the account performance. Give it a second to load because there's quite a bit of trading going on. Okay, so let's go ahead and put that there. Bring this down. Zoom this out a little bit if I can. Maybe it won't let me. Yeah, okay, here we go. Yeah, so it'll say here, 1.68 profit factor. Obviously, profit factor is greater when you aren't exiting at 4 p.m. every single day, and re-entering the trade because you're trading less and it's treating those as full trades rather than here we're having to constantly re-enter the market. But here you see that the max drawdown achieved is like $1,571.58. Whereas what actually happened is at one point we were down almost 17, well, about 1650. And that is the open drawdown based on like account balance high, account balance low. Um, that's what you would actually experience if you were running this live with the prop firm because their trailing drawdown is based on open and not closed. And so this is one of the dangers of if you're going to build a algorithmic trading strategy or portfolio strategies, you want to make sure you have some way to identify the open drawdown and not just the closed drawdown. Because everything looks great in when you only look at the closes of all the trades. But yeah, this is what I'm going to be running. I'm going to finish building out the rest, or at least converting the rest of the strategies in my personal SPY portfolio over to this MES futures variant. And I'm actually going to take this live even before all that conversion is done. Because my goal is to get this $5,000 small account challenge started as quickly as possible, as well as get the prop account running on this as quickly as possible as well. That way, it won't exactly be the same as if I started at the beginning of 2026, but it'll be pretty close to um, starting these challenges at the beginning of this year. And then hopefully by the end of this year, I can show you that not only these strategies continue to work a second year in a row, but they actually grew a small account and also got funded payouts. So that's my hope. I think it's a lot easier to run these when you don't have to play by all these dumb restrictions and rules. But if you could just swing trade SPY, that even with options, that is more ideal. But I have confidence in what I have built and what I do. So that will be the next playlist in the series. And then what I'll do for this beginner series is probably just make a video once at the end of each year to just show, okay, here's the end of year performance, or here's the performance for the year now that the year has ended. So look forward to that, and look forward to updates about the small account challenge alongside the funded prop account challenge, both of which will be happening simultaneously with this Quantower strategy that is a super strategy of my SPY strategies.